So, if you're over 65, I need you to listen very carefully. I want to talk about your life savings, the money you've worked for, the money you've been careful with, the money you believe is sitting safely in conservative investments, protecting you for the rest of your life. I'm here to tell you that for millions of seniors, that feeling of safety is a dangerous illusion. There is a silent thief in your portfolio, an invisible force that is systematically draining the value of your nest egg. And the worst part? It's happening inside the very investments you were told were perfect for seniors. Today, I'm going to expose the 3 safe investments that are secretly losing you money every single day. I want to tell you a story about a woman named Margaret. At 73, Margaret had always prided herself on being careful. She was a retired high school principal, a widow, and she had done everything right. She'd saved up a nest egg of $485,000. 3 years ago, she went to a financial advisor, a man with a fancy office and a reassuring smile. She told him she was afraid of the stock market's volatility and needed safe, steady income. He told her exactly what she wanted to hear. He said, "Margaret, you're conservative, practical, and focused on preservation. I have 3 investment strategies that are absolutely perfect for you. They're safe, they provide steady income, and they will protect your principal." Those 3 strategies are probably sitting in your portfolio right now. First, a high-yield savings account. Second, a portfolio of long-term CDs. And third, a collection of safe dividend stocks from big, stable utility companies. It sounded perfect. The advisor used all the right words: FDIC insured, guaranteed returns, blue-chip stability. Margaret left that office feeling secure, relieved, and protected. But what that advisor didn't talk about was the single biggest threat to any retiree's wealth: inflation. Fast forward 3 years. Margaret is sitting at her kitchen table, looking at her statements. Her safe investments have performed exactly as promised, but the cost of everything else in her life has skyrocketed. Her grocery bill is up nearly 35%. Her prescription drug costs have jumped over 60%. Her property taxes and homeowners insurance have climbed by thousands of dollars a year. But her investment income? It has barely budged. Her advisor promised her a return of about 1.5% a year. But with inflation running over 4%, she was actually losing 2.7% of her money's real value, its purchasing power, every single year. She wasn't safe. She was slowly going broke in the safest investments possible. Margaret's story is a wake-up call. Let's break down these 3 safe investments because understanding the trap is the only way to escape it. The first trap is the one that feels the most secure: the high-yield savings account and other cash equivalents. Your advisor, like Margaret's, probably told you to keep a large chunk of your money here for liquidity and safety. It's FDIC insured. The dollar amount can never go down. It feels like the ultimate safe haven. But this is what the industry calls nominal safety. It means the number of dollars you have won't decrease. What it completely ignores is real safety, whether those dollars will be able to buy you anything in the future. Margaret's high-yield account was paying 0.5%. Let me repeat that: half of 1%. At a time when her cost of living was rising by over 4%, she was getting a high yield of 0.5%. Every single year, every $100,000 she had in that account lost $3,500 in real-world buying power. This isn't an investment. It's a guaranteed loss. The bank was taking her money, lending it out for mortgages and credit cards at much higher rates, and paying her a pittance for the privilege. The high-yield savings account wasn't a safe haven. It was a wealth-destroying machine. The second trap is perhaps the most popular safe investment for seniors: the certificate of deposit, or CD. CDs feel even safer than savings accounts. You get a guaranteed return, locked in for a set period. It feels stable and predictable. When Margaret put a large portion of her money into a portfolio of CDs averaging a 1.8% annual return, she thought she was making the ultimate prudent decision. But here's the brutal truth about CDs in an inflationary environment. You are not locking in a gain. You are locking in a loss. Think about it. Margaret locked in a 1.8% return, but inflation was running at 4.2%. She guaranteed that her money would lose 2.4% of its purchasing power every single year for the term of the CD. And what if she wanted to get out? She'd have to pay a substantial penalty, often wiping out any interest she had earned. The CD trap is particularly insidious because it preys on your desire for certainty. But the certainty it provides is the certainty of becoming poorer over time. While you are happily collecting your 1.8%, the cost of your groceries, your gas, and your healthcare is rising at double or triple that rate. The guaranteed return is meaningless when it guarantees a real loss, not a real gain. This brings us to the third trap, the one that sounds the most sophisticated, the safe dividend stock. Margaret's advisor, Charles, put her into stocks from established blue-chip utility companies. His reasoning sounded perfect. These companies have been around for 100 years, he said. People always need electricity and gas. They pay a steady, reliable dividend. It's the safest way to be in the market. He was wrong. While these stocks feel safe, they have hidden risks that make them particularly vulnerable during periods of high inflation. First, many of these companies, like utilities, are in heavily regulated industries. That means they can't just raise their prices whenever they want to. When their own costs, for fuel, for labor, for materials, are skyrocketing due to inflation, they have to go to a government commission to ask for permission to raise your rates. This process is slow, and they often don't get the full increase they need. This squeezes their profits, and when profits get squeezed, what's the first thing to get cut? The dividend. The very income you were counting on is now at risk. Second, when inflation is high, the Federal Reserve raises interest rates to fight it. When that happens, investors can suddenly get a safe, guaranteed return from new government bonds that is higher than the dividend from a utility stock. So, they sell the risky stock to buy the safer bond. This selling pressure drives the price of your safe dividend stock down. So, at the exact moment when you need your investments to protect you from inflation, these safe stocks can hit you with a double whammy, a dividend cut and a falling stock price. Margaret had fallen into all three of these traps. Her portfolio was a textbook example of what I call the conservative investor's nightmare. A collection of investments that felt safe but were perfectly designed to fail in the one environment that is most dangerous to retirees, a period of rising costs. As she read further, she learned about something called sequence of returns risk. The danger that poor investment performance early in retirement could permanently damage a retiree's financial security. But even more troubling was what the article called sequence of inflation risk. The possibility that high inflation early in retirement could erode purchasing power so significantly that even good investment performance later couldn't compensate for the damage. Margaret had encountered both risks simultaneously. Her conservative investments had provided poor returns precisely when inflation had begun accelerating, creating a perfect storm of financial erosion. She checked out several books and drove home as darkness fell. That night, she spread the books across her kitchen table and began what she would later describe as her financial education. For the first time in her life, she studied investment theory, inflation economics, and retirement planning strategies with the same intensity she had once applied to developing curriculum for her students. What she learned over the following weeks was both enlightening and devastating. The financial services industry, she discovered, was filled with advisors like Charles, who genuinely believed they were helping clients by steering them toward safe investments. These advisors had been trained to focus on avoiding short-term losses rather than ensuring long-term purchasing power. They emphasized the prevention of principal loss while ignoring the gradual destruction of buying power. Margaret learned that the term safe had two different meanings in finance. There was nominal safety, ensuring that the dollar amount of your investments didn't decline, and real safety, ensuring that your purchasing power was preserved over time. Charles had provided her with nominal safety while exposing her to significant real risk. She also learned that the three types of investments Charles had recommended for her were particularly problematic for retirees during inflationary periods. High-yield savings accounts, despite their name, rarely yielded returns that exceeded inflation. Their primary benefit was liquidity and FDIC insurance, But for money that wouldn't be needed for years, these benefits came at an enormous opportunity cost. Certificates of deposit were even more problematic during inflationary periods. While they provided guaranteed returns, those returns were fixed at the time of purchase. If inflation accelerated after the CD was purchased, the investor was locked into receiving returns that might be far below the rate of price increases. Moreover, if interest rates rose significantly, CD holders couldn't take advantage of higher returns without paying substantial penalties for early withdrawal. The dividend stocks Charles had selected for her portfolio seemed safer but carried their own hidden risks. Many of the utility companies he'd chosen operated in heavily regulated industries where rate increases lagged behind cost increases. During inflationary periods, these companies often faced profit pressure that led to dividend cuts. Additionally, when interest rates rose to combat inflation, dividend stocks often declined in value as investors moved money to bonds and other fixed-income investments offering higher yields. As Margaret absorbed this information, she felt a mixture of anger and sadness. Anger at Charles for not explaining these risks more thoroughly, and anger at herself for not asking better questions. But mostly she felt sad about the time that had been lost. At 73, she didn't have decades to recover from poor investment decisions. Every year mattered, and 3 years of poor performance had put her in a hole that would be increasingly difficult to escape. But Margaret was not someone who gave up easily. After 2 weeks of intensive study, she made an appointment to meet with Charles again. This time, however, she walked into his office carrying not just her statements, but also a list of pointed questions and a much deeper understanding of what had been happening to her money. Charles greeted her with the same warm smile and professional manner she remembered from their first meeting. His office looked exactly the same: the polished mahogany desk, the diplomas and certifications on the wall, the comfortable leather chairs that conveyed stability and success. "Mrs. Whitmore, how wonderful to see you again. I was just reviewing your accounts yesterday, and I'm pleased to report that everything is performing exactly as we expected. Your principal is secure, you're receiving steady income, and you haven't lost a penny to market volatility. Frankly, given how turbulent the markets have been lately, I think we can both feel very satisfied with the conservative approach we've taken." Margaret opened her notebook and placed it on his desk. "Charles, I want to talk about something you call steady income and something I call declining purchasing power." Charles looked puzzled. "I'm not sure I understand." 3 years ago, my investment income could cover about 60% of my living expenses. Today, that same income covers only about 45%. My investments have been earning returns of around 1.5% annually, but my living expenses have been increasing by about 4% per year. How is that a successful investment strategy? Charles shifted uncomfortably in his chair. "Mrs. Whitmore, we always knew that inflation was a factor. But the most important thing was protecting your principal. Think about what would have happened if we'd put your money into the stock market 3 years ago. You might have lost 20 or 30% during the market downturns we've experienced." "But Charles, I have lost 20 or 30%. I've lost it to inflation. The difference is that market losses are usually temporary and often recover. Inflation losses are permanent. Every dollar of purchasing power I've lost is gone forever." Margaret opened her notebook and showed Charles her calculations. "I've been tracking my expenses very carefully. 3 years ago, I could buy the same groceries for $280 that now cost me $375. My medications have gone from $95 per month to $156. My insurance costs have increased by over 50%. Meanwhile, my investment income has increased by less than 3% total." She turned to another page. "I've also been studying investment theory, something I probably should have done before we first met. I learned about something called sequence of inflation risk. Do you know what that is?" Charles admitted he wasn't familiar with the term. "It's the risk that high inflation early in retirement can permanently damage a retiree's financial security. Even if inflation moderates later, the purchasing power lost in the early years can never be recovered if the investment returns don't exceed the inflation rate during that critical period." Margaret continued, "I also learned that the 3 types of investments you recommended for me, high-yield savings, CDs, and dividend stocks, are particularly vulnerable during inflationary periods. Yet when we met 3 years ago, you didn't mention inflation risk even once. You talked about market risk, interest rate risk, and credit risk, but never inflation risk. Why? Charles was quiet for a long moment. When he finally spoke, his voice had lost some of its confident tone. Mrs. Whitmore, I want you to know that I genuinely believed I was acting in your best interests. Most clients your age are primarily concerned about preserving principal. They're afraid of losing money in the stock market, and they want investments they can understand and feel comfortable with. But comfort isn't the same as safety, is it? Margaret asked. I felt comfortable with these investments, but they haven't actually been safe for my financial future. Charles nodded slowly. You're right, and I apologize for not explaining the inflation risk more clearly. In my training and experience, we've always focused on preventing nominal losses rather than preserving purchasing power. It's easier to explain to clients, and it avoids the complexity of trying to predict inflation rates. The problem, Margaret said, is that inflation isn't something we need to predict. It's something we need to prepare for. Even moderate inflation of 2 to 3% annually can cut purchasing power in half over 20 years. For someone my age, that's exactly the time horizon I need to worry about. Margaret had come to the meeting prepared not just to voice complaints, but to discuss solutions. She had spent considerable time researching alternative investment approaches that might better address her situation. I've been reading about something called real return investments. Investments that are specifically designed to provide returns above the inflation rate. I'd like to understand why we didn't consider any of these options 3 years ago. Charles pulled out a legal pad and began taking notes. What types of investments are you referring to? Margaret opened another section of her notebook. Treasury inflation-protected securities, for one. Tips. Bonds are specifically designed to protect against inflation. The principal adjusts upward with inflation, and the interest payments are based on the adjusted principal. Why didn't we consider putting at least part of my portfolio into TIPS? Well, Charles said, TIPS were yielding very low real returns 3 years ago. The inflation protection came at the cost of current income. But that's exactly the trade-off I needed to make, isn't it? I needed to give up some current income to protect against future purchasing power erosion. Instead, we maximized current income and left me completely exposed to inflation risk. Margaret continued. I also read about I-bonds, inflation-adjusted savings bonds from the Treasury. They're backed by the full faith and credit of the U.S. government. So they're as safe as FDIC insurance, but they provide real protection against inflation. There are purchase limits, but I could have been buying $10,000 per year. Over 3 years, that would have been $30,000 earning inflation-adjusted returns instead of losing purchasing power. Charles was writing furiously. You're absolutely right about both TIPS and I-bonds. I should have discussed those options with you. There's more, Margaret said. I've been reading about real estate investment trusts that focus on properties with inflation escalation clauses in their leases. I've learned about commodity funds that tend to perform well during inflationary periods. I've studied equity funds that focus on companies with pricing power, businesses that can raise their prices along with inflation. She turned to another page in her notebook. I even learned about international bond funds that provide exposure to currencies of countries with lower inflation rates than ours. None of these investments is perfect, but all of them would have provided some protection against what's been happening to my purchasing power. Charles set down his pen. Mrs. Whitmore, I have to admit that you've done more research into inflation protection strategies than I normally do for clients. Most people your age aren't interested in the complexity of these approaches. But that's the problem, isn't it? Margaret said. You assumed I wasn't interested in complexity without asking. You assumed I was primarily concerned about short-term volatility without understanding that I was actually more concerned about long-term purchasing power. You made decisions based on stereotypes about older investors, rather than based on my specific situation and needs. The conversation continued for another hour, during which Margaret outlined a new investment strategy she wanted to implement. It wasn't radically aggressive, but it was significantly different from the approach Charles had originally recommended. She wanted to move a substantial portion of her money into inflation-protected securities and real return investments. She wanted to reduce her exposure to traditional CDs and savings accounts. She wanted to add some international diversification and some exposure to assets that historically performed well during inflationary periods. Most importantly, she wanted to change the entire framework for evaluating her investment performance. Instead of measuring success by nominal returns and principal preservation, she wanted to measure success by real returns and purchasing power preservation. Charles agreed to work with her on implementing these changes, but he also made an admission that surprised Margaret. "Mrs. Whitmore, I want you to know that this conversation has been educational for me as well. I realize that my training and approach have been focused too heavily on preventing nominal losses and not heavily enough on ensuring real returns. You've highlighted a blind spot in my practice that affects not just you, but probably many of my other retired clients." He paused, then continued, "I'd like your permission to use your experience as a case study in my practice. Obviously without using your name or identifying information, but I think other clients could benefit from understanding the inflation risks you've identified." Margaret agreed, with one condition. "I want you to be completely honest about the mistakes we made together. I want other people to understand not just the risks of inflation, but the risks of making financial decisions based on fear rather than careful analysis." Over the following months, Margaret worked with Charles to gradually reposition her portfolio. The transition wasn't immediate. Some of her CDs couldn't be moved without penalties, and market timing considerations required a methodical approach. But slowly, her investment mix began to shift toward assets that provided better inflation protection. The changes weren't without risks. Her new portfolio was more volatile than her old one, with monthly fluctuations that sometimes made her nervous. Some months her statements showed nominal losses that her old portfolio never would have experienced. But she had learned to focus on different metrics. Instead of worrying about short-term principal fluctuations, she tracked her portfolio's real return, its performance relative to inflation. Instead of celebrating modest nominal gains, she celebrated months when her investments gained more than the rate of price increases in her expenses. Most importantly, she began to see signs that her purchasing power erosion was slowing and eventually reversing. Her investment income, while more variable than before, was beginning to keep pace with her rising expenses. Some months it even exceeded the increase in her living costs. But Margaret's story wasn't just about her own financial recovery. She had learned something important about the advice industry and the way financial decisions are often made for older investors. She realized that the financial services industry had developed a set of conventional wisdom about older investors that wasn't necessarily true or helpful. The industry assumed that people over 65 were primarily concerned with capital preservation, risk aversion, and current income. It assumed they couldn't tolerate volatility and weren't interested in complex investment strategies. These assumptions led to cookie-cutter recommendations that often failed to address the real risks facing retirees. By focusing so heavily on protecting against market losses, advisors like Charles often exposed their clients to inflation losses that could be even more damaging over the long term. Margaret began to understand that successful retirement investing required a completely different mindset than the conventional wisdom suggested. It required thinking about risk in terms of purchasing power rather than principal preservation. It required accepting some volatility in exchange for inflation protection. It required a longer-term perspective that focused on real returns rather than nominal safety. She also learned that the timeline for retirement investing was often much longer than people realized. At 73, she potentially had 15 to 20 years of retirement ahead of her. Over that time horizon, even modest inflation could cut her purchasing power in half if her investments didn't provide real returns above the inflation rate. The conventional wisdom that older investors should focus on safe investments like savings accounts, CDs, and dividend stocks was not only wrong, but potentially dangerous. These investments might feel safe, but they provided no protection against the steady erosion of purchasing power that inflation represented. Margaret's experience highlighted 3 specific investment mistakes that were particularly common among retirees, and particularly dangerous during inflationary periods. The first mistake was the over-reliance on cash and cash equivalents. Many retirees kept substantial portions of their portfolios in savings accounts, money market funds, and short-term CDs, because these investments felt safe and provided easy access to money. But during inflationary periods, these investments guaranteed real losses. They provided nominal safety while ensuring purchasing power destruction. The second mistake was the misunderstanding of CD safety. While CDs provided guaranteed nominal returns, they locked investors into fixed returns that might be far below inflation rates. They also prevented investors from taking advantage of rising interest rates without paying substantial penalties. During the inflationary period Margaret experienced, her CDs had provided the worst risk-adjusted returns in her portfolio. The third mistake was the over-reliance on dividend stocks from mature companies. While these stocks felt safe and provided current income, they often performed poorly during inflationary periods. Many of the companies that paid high dividends were in mature, regulated industries with limited pricing power. When costs rose faster than these companies could raise their prices, their profits declined and their dividends were often cut. Margaret's story illustrated how these three safe investments could combine to create a portfolio that was almost perfectly designed to lose purchasing power during inflationary periods. Her original portfolio had been conservative in name, but risky in practice. But her story also illustrated that it was possible to address these problems, even for investors well into retirement, by focusing on real returns rather than nominal safety, by accepting some volatility in exchange for inflation protection, and by diversifying into assets that historically performed well during inflationary periods. She had been able to stabilize and eventually improve her financial situation. The key was understanding that retirement investing involved a different set of trade-offs than most people realized. The trade-off wasn't between safety and risk, but between different types of risk. Nominal risk, the risk of short-term principal fluctuations, had to be balanced against real risk, the risk of long-term purchasing power erosion. For most retirees, the greater long-term risk came from inflation rather than market volatility. Market downturns were usually temporary and often recovered within a few years. Inflation losses were permanent and accumulated over time. Margaret's experience also highlighted the importance of ongoing financial education for retirees. The financial landscape was constantly changing, and strategies that made sense in one economic environment might be inappropriate in another. Retirees couldn't simply set their portfolios on autopilot and expect good results over 10 or 20-year periods. 6 months after her meeting with Charles, Margaret received a call from her daughter Jennifer. "Mom, you sound different lately. More confident, maybe? Are you doing something new?" Margaret looked around her kitchen where financial books and investment statements were still spread across the table most days. She had become something she never expected to be in her 70s, a student again, constantly learning about markets and investments and economic trends. "I guess I am doing something new," she said. "I'm taking control of my financial future instead of just hoping everything will work out." "That's wonderful, Mom. Robert would be so proud of how you've handled everything." After Jennifer hung up, Margaret reflected on how much had changed since that morning 6 months earlier when she'd first realized her safe investments were failing her. She wasn't just financially better off, she was psychologically stronger. She understood her situation and had a plan for addressing it. But she also understood that her story wasn't unique. All around her, she suspected, were other retirees in similar situations, people who had made conservative investment choices that felt safe, but were actually exposing them to serious inflation risk. She thought about her neighbor Ruth, who often mentioned how her fixed income seemed to buy less each month. She thought about the people she saw at the senior center, many of whom seemed increasingly worried about their finances but didn't know what to do about it. Margaret realized that her experience could be valuable to others facing similar challenges. She began volunteering at the library, helping other seniors research financial topics and understand investment basics. She wasn't providing investment advice, she was careful about that, but she was sharing the research skills and analytical framework that had helped her understand her own situation. Through these conversations, she learned that her experience was indeed common. Many retirees had been steered towards safe investments that provided poor inflation protection. Many had been told that their primary concern should be preserving principal rather than preserving purchasing power. Many had accepted modest nominal returns without understanding the real risks they were accepting. But she also learned that knowledge could be empowering. When people understood the difference between nominal and real returns, they could make better decisions about their investment mix. When they understood inflation risk, they could evaluate their portfolios differently. When they understood that volatility and risk weren't the same thing, they could consider investment options they had previously dismissed. Margaret's transformation from victim of inflation to informed investor took about a year. During that time, her financial situation improved significantly, but more importantly, her understanding and confidence improved even more. She had learned that successful retirement investing required a willingness to challenge conventional wisdom, to ask difficult questions, and to prioritize long-term purchasing power over short-term comfort. She had learned that safe investments weren't necessarily safe, and that avoiding volatility could be riskier than accepting it. Most importantly, she had learned that it was never too late to make positive changes, even for investors well into retirement. The key was understanding the real risks and opportunities, making decisions based on analysis rather than fear, and maintaining the flexibility to adjust strategies as circumstances changed. 2 years after her first meeting with Charles, Margaret sat in the same kitchen where she had first realized her financial problems. But this time, instead of panic, she felt something approaching satisfaction as she reviewed her quarterly investment statements. Her portfolio was worth slightly more than it had been when she'd started working with Charles 3 years earlier. But more importantly, its purchasing power had grown significantly. Her investment income was now keeping pace with her rising expenses, and she had built some reserves for unexpected costs. The investments that had once seemed so safe, her savings accounts, CDs, and dividend stocks, now represented a much smaller portion of her portfolio. In their place were Treasury inflation-protected securities, international bond funds, real estate investment trusts, and equity funds focused on companies with pricing power. Her new portfolio was more volatile than her old one, but it was actually safer in the most important sense. It protected her purchasing power over time. Margaret had also developed new habits that supported her financial security. She continued her financial education, reading investment publications and attending seminars. She tracked inflation measures and adjusted her spending and investment strategies accordingly. She maintained detailed records that helped her understand the real performance of her investments. But perhaps most importantly, she had developed a new relationship with financial risk. Instead of trying to avoid all risks, she focused on managing the risks that were most likely to threaten her long-term financial security. Instead of seeking comfort, she sought understanding. The phone rang, and Margaret saw it was Charles calling with her quarterly portfolio review. "Mrs. Whitmore," he said, "I have your latest statements here, and I'm pleased to report that your portfolio is performing very well on a real return basis. Your investments gained 7.2% last quarter, while inflation was running at about 3.8%, so you achieved a real return of approximately 3.4%. Margaret smiled. 2 years ago, Charles had never mentioned real returns. His vocabulary had been full of terms like principal preservation and guaranteed income. Now their conversations focused on purchasing power and inflation-adjusted performance. "That's good news, Charles. How does that compare to the broader market?" "Very well, actually. Your portfolio is outperforming both the S&P 500 and the bond market on a real return basis over the past year. The inflation-protected securities and international diversification have been particularly helpful." They spent several minutes reviewing the performance of different components of her portfolio and discussing adjustments that might be appropriate given changing economic conditions. "Charles," Margaret said as their call was ending, "I want to thank you for being willing to change your approach when I challenged you 2 years ago. I know it wasn't easy to admit that your initial recommendations weren't working. Mrs. Whitmore, I want to thank you for educating me. Your experience has changed the way I work with all my retired clients. I now have conversations about inflation risk that I never had before. I recommend investment strategies that I never would have considered. Frankly, you made me a better advisor." After the call ended, Margaret returned to her financial books and statements. She had become something she never expected. a sophisticated investor who understood complex financial concepts and made informed decisions about her future. But she had also become something even more important, an example of what was possible for retirees who were willing to challenge conventional wisdom and take control of their financial futures. Margaret's story was ultimately about more than just investments. It was about the importance of continuing to learn and grow, even in the later stages of life. It was about the danger of accepting simple solutions to complex problems. It was about the difference between feeling safe and actually being safe. Most importantly, it was about the hidden risks that many retirees faced without realizing it, risks that came not from dramatic market crashes or financial fraud, but from the slow, steady erosion of purchasing power that supposedly safe investments failed to prevent. The three investment mistakes that had initially threatened Margaret's financial security, over-reliance on cash equivalents, misunderstanding of CD safety, and overemphasis on dividend stocks, were mistakes that millions of retirees were probably making without realizing it. But Margaret's story also demonstrated that these mistakes could be corrected, even by investors well into retirement. The key was understanding the real nature of the risks involved and being willing to accept some nominal volatility in exchange for better long-term purchasing power protection. As Margaret often told the people she helped at the library, retirement investing wasn't about finding perfectly safe investments. Such investments didn't exist. It was about understanding and managing the trade-offs between different types of risk. The choice wasn't between risk and safety. It was between the risk of short-term volatility and the risk of long-term purchasing power erosion. For most retirees, especially those with 10 or 20 years of retirement ahead of them, the greater risk came from inflation rather than market fluctuations. Margaret had learned this lesson the hard way, watching 3 years of supposedly safe investments slowly erode her financial security. But she had also learned that knowledge and appropriate action could reverse even serious financial problems. Her experience offered hope to other retirees facing similar challenges. It was never too late to make better financial decisions. It was never too late to challenge conventional wisdom. It was never too late to take control of one's financial future. But her experience also offered a warning about the hidden dangers of financial complacency. The investments that felt safest might actually be the riskiest over the long term. The advisors who promised the most comfort might be providing the least protection. The strategies that seemed most conservative might actually be the most likely to lead to financial problems. Margaret's journey from financial victim to informed investor had taken nearly 2 years and had required considerable effort and education. But the results, both financial and psychological, had been worth the investment. She was now financially more secure than she had been in years. More importantly, she was psychologically more confident about her ability to navigate whatever financial challenges might arise in the future. As she closed her notebook that evening and put away her statements and financial books, Margaret reflected on how much had changed since that morning 2 years earlier when she had first realized that her safe investments were failing her. She had learned that true financial security in retirement required much more than just conservative investments. It required ongoing education, careful analysis, and the willingness to make difficult decisions based on facts rather than feelings. But she had also learned that such security was achievable, even for people who started their financial education late in life. The key was understanding that retirement wasn't a time to stop learning and growing. It was a time when continued learning and growth were more important than ever. Margaret's story was a reminder that financial planning was not a one-time event, but an ongoing process. Economic conditions changed, investment markets evolved, and personal circumstances shifted over time. Successful retirement required the flexibility to adapt to these changes rather than simply hoping that initial decisions would remain appropriate indefinitely. Her experience had transformed her from a passive recipient of financial advice to an active participant in her own financial future. She had learned to ask better questions, to understand complex concepts, and to make informed decisions about her investments. But most importantly, she had learned that it was possible to take control of her financial destiny, even as someone in her 70s who had never considered herself particularly sophisticated about investments. Margaret's transformation offered both inspiration and practical guidance for other retirees facing similar challenges. Her story demonstrated that the conventional wisdom about safe investments for seniors could be dangerously misleading, but it also demonstrated that better alternatives were available for those willing to seek them out. As she turned off the kitchen light that evening, Margaret felt something she hadn't experienced in the early days of her retirement: genuine optimism about her financial future. She understood the risks she faced. She had strategies for managing those risks, and she had the knowledge and confidence to adjust those strategies as needed. Her journey from financial anxiety to financial confidence had been challenging, but it had also been deeply rewarding. She had proven to herself that it was never too late to learn, never too late to change, and never too late to take control of one's destiny. Margaret's story was ultimately a story of empowerment, the empowerment that came from knowledge, understanding, and the willingness to challenge assumptions that were no longer serving her well. It was a story that offered both warning and hope to anyone facing similar financial challenges in retirement. The three safe investments that had initially threatened her financial security, high-yield savings accounts, certificates of deposit, and dividend stocks from mature companies, had indeed been losing her money, just not in the obvious way that most people would recognize. Margaret's story might have ended there, with her personal financial recovery and newfound confidence. But life, as she had learned many times before, rarely followed predictable patterns. 3 months after her successful quarterly review with Charles, she received a phone call that would test everything she had learned about managing financial risk and uncertainty. The call came on a Tuesday morning in October. Margaret was in her garden, harvesting the last tomatoes before the first frost, when her neighbor Ruth appeared at the fence between their properties. Ruth looked distraught, clutching a handful of papers that Margaret recognized as bank and investment statements. "Margaret, I know you've been helping people at the library with financial questions, and I was wondering, could you take a look at something for me? I'm really worried." Margaret invited Ruth into her kitchen, the same space where she had first confronted her own financial problems 2 years earlier. Ruth spread her papers across the familiar oak table with shaking hands. "I got a call yesterday from my bank," Ruth explained. "They're closing my high-yield savings account because the bank is being acquired. They're transferring my money to a regular savings account that pays almost nothing. And my financial advisor is suggesting I put it all into a 5-year CD that pays 2.1%. Margaret studied Ruth's statements. Her neighbor had $220,000 in savings and investments, accumulated over 40 years as a nurse. Like Margaret's original portfolio, Ruth's money was heavily concentrated in what most people would consider safe investments: savings accounts, short-term CDs, and a small collection of dividend stocks from utility companies. "Ruth, before we talk about where to put your money, can you tell me about your expenses? What does it cost you to live each month?" Ruth pulled out a small notebook, much like the one Margaret had kept. "My house is paid off, but property taxes are about $2,800 per year now. Insurance is $1,900. Utilities average about $180 per month. Food is around $400 per month now. It used to be much less. Medical expenses that Medicare doesn't cover run about $300 per month. Car insurance, maintenance, gas, maybe another $250 per month. I'd say I need about $2,800 per month to cover everything." Margaret did quick calculations. Ruth needed $33,600 per year in income, but her current investments were generating only about $4,200 annually, less than 13% of her needs. The rest was coming from Social Security and a small pension from the hospital where she'd worked. "Ruth, you're facing the same problem I faced 2 years ago. Your savings and investments aren't keeping up with inflation. If you put that money into a 2.1% CD for 5 years, you'll be guaranteeing that your purchasing power continues to decline." Over the next hour, Margaret shared with Ruth everything she had learned about inflation risk, real returns, and the hidden dangers of supposedly safe investments. She explained how Treasury inflation-protected securities worked, how international bond funds could provide currency diversification, and how carefully selected equity investments could offer better long-term purchasing power protection than traditional safe investments. But as they talked, Margaret realized that Ruth's situation was more complex than her own had been. Ruth was 81 years old, 8 years older than Margaret. She had less time to recover from investment mistakes, less ability to earn additional income if her investments performed poorly, and more concern about accessing her money if she needed it for medical expenses. Margaret, what you're describing sounds sensible, but it also sounds complicated and risky. What if the stock market crashes right after I invest? What if interest rates change and those bond funds lose value? At my age, can I afford to take those risks? Margaret recognized the same concerns she had felt 2 years earlier. The conventional wisdom about age and investment risk was deeply ingrained, and it took time to develop a different way of thinking about financial security. Ruth, let me ask you this. Can you afford not to take those risks? If you put your money in a 2.1% CD for 5 years, and inflation continues at 3 to 4% annually, you'll lose about 15% of your purchasing power. That's not a potential loss, it's a guaranteed loss. They spent another hour working through different scenarios and investment options. Margaret showed Ruth how to research Treasury inflation-protected securities on the Treasury Department's website. She explained how to evaluate bond funds and equity funds based on their expense ratios and historical performance relative to inflation. Most importantly, she helped Ruth understand the difference between volatility and risk. Volatility meant that investment values would fluctuate over time, sometimes going down in the short term. Risk meant the possibility of not having enough money to maintain her standard of living over the long term. For someone your age, Margaret explained, the biggest risk isn't that your investments might go down next month or next year. The biggest risk is that your money might not maintain its purchasing power over the next 10 or 15 years. Ruth left that afternoon with a list of resources to study and a promise to meet again the following week. Margaret felt good about being able to share what she had learned, but she also felt the weight of responsibility. Ruth was trusting her with guidance that could significantly impact her financial future. Over the following days, Margaret found herself thinking more deeply about the broader implications of what she had experienced and what she was now sharing with others. How many people like Ruth were there? How many retirees were making financial decisions based on outdated conventional wisdom that no longer served their interests? She decided to do some research. At the library, she found demographic data about retirement savings and investment patterns among older Americans. What she learned was sobering. According to Federal Reserve data, the median retirement savings for Americans between the ages of 65 and 74 was only $164,000. For those 75 and older, it was even less. These amounts were far below what most financial experts considered adequate for a comfortable retirement. But even more troubling was data. The conventional wisdom about age and investment risk was deeply ingrained, and it took time to develop a different way of thinking about financial security. Ruth, let me ask you this. Can you afford not to take those risks? If you put your money in a 2.1% CD for 5 years, and inflation continues at 3 to 4% annually, you'll lose about 15% of your purchasing power. That's not a potential loss, it's a guaranteed loss. They spent another hour working through different scenarios and investment options. Margaret showed Ruth how to research Treasury inflation-protected securities on the Treasury Department's website. She explained how to evaluate bond funds and equity funds based on their expense ratios and historical performance relative to inflation. Most importantly, she helped Ruth understand the difference between volatility and risk. Volatility meant that investment values would fluctuate over time, sometimes going down in the short term. Risk meant the possibility of not having enough money to maintain her standard of living over the long term. For someone your age, Margaret explained, the biggest risk isn't that your investments might go down next month or next year. The biggest risk is that your money might not maintain its purchasing power over the next 10 or 15 years. Ruth left that afternoon with a list of resources to study and a promise to meet again the following week. Margaret felt good about being able to share what she had learned, but she also felt the weight of responsibility. Ruth was trusting her with guidance that could significantly impact her financial future. Over the following days, Margaret found herself thinking more deeply about the broader implications of what she had experienced and what she was now sharing with others. How many people like Ruth were there? How many retirees were making financial decisions based on outdated conventional wisdom that no longer served their interests? She decided to do some research. At the library, she found demographic data about retirement savings and investment patterns among older Americans. What she learned was sobering. According to Federal Reserve data, the median retirement savings for Americans between the ages of 65 and 74 was only $164,000. For those 75 and older, it was even less. These amounts were far below what most data Margaret had printed out. So what you're saying is that by trying to avoid risk, we're actually taking the biggest risk of all? Exactly. We're avoiding the risk of short-term losses while accepting the certainty of long-term purchasing power decline. Over the following weeks, Ruth worked with her financial advisor to gradually restructure her portfolio along the lines Margaret had suggested. Like Margaret, she moved money out of low-yielding savings accounts and short-term CDs and into inflation-protected securities and carefully selected bond and equity funds. The transition wasn't smooth. Ruth's new investments were more volatile than her old ones, and some months her statements showed nominal losses that made her nervous. But Margaret helped her focus on the right metrics, real returns and purchasing power protection rather than short-term nominal performance. More importantly, Ruth began to see improvements in her monthly cash flow. Her investment income became more variable, but also more substantial. Instead of earning $350 per month from her savings and investments, she was averaging closer to $600 per month, with the potential for growth over time. But Ruth's experience also highlighted some of the challenges that made retirement investing so difficult for many people. The financial services industry was still heavily oriented toward conventional wisdom about age and risk. Many advisors were reluctant to recommend more aggressive investment strategies for older clients, even when those strategies might better serve their long-term interests. Ruth's original advisor had been skeptical of the changes she wanted to make. He had emphasized the risks of her new approach while downplaying the risks of her old approach. Like Charles 2 years earlier, he had been trained to focus on preventing nominal losses rather than ensuring real returns. This experience reinforced Margaret's growing conviction that financial education was crucial for retirees. Without understanding the concepts and trade-offs involved, it was easy for people to make decisions based on fear rather than analysis, or to rely on advisors whose training might not align with their clients' best interests. Margaret began to spend more time at the library, not just helping individuals like Ruth, but also attending financial planning seminars and workshops. She was struck by how often these events focused on generic advice that didn't address the specific challenges facing retirees during inflationary periods. Most seminars still emphasized the conventional wisdom about age-appropriate investing. They advised older participants to focus on capital preservation and current income to avoid volatility, and to gradually shift their portfolios towards safer investments like bonds and CDs as they aged. But Margaret now understood that this conventional wisdom was based on assumptions that were no longer valid. It assumed that inflation would remain low and stable, and that retirees had short time horizons, and that nominal safety was more important than real returns. During the question and answer portion of one seminar, Margaret asked the presenter about inflation protection strategies for retirees. What advice would you give to someone who's concerned that their current investment income isn't keeping up with rising living costs? She asked. The presenter's answer was disappointing but not surprising. He suggested that retirees concerned about inflation should consider moving some money from savings accounts to CDs with slightly higher yields, or perhaps adding some dividend-paying stocks to their portfolios for additional income. These were exactly the strategies that Margaret had learned were inadequate for dealing with significant inflation risk. The presenter was recommending minor adjustments to conventional approaches rather than fundamental changes in strategy. After the seminar, Margaret approached the presenter privately and shared some of her research about inflation risks and real return investing. He was polite but dismissive. Mrs. Whitmore, I appreciate your research, but my experience is that people your age are primarily concerned with preserving their capital and avoiding volatility. The strategies you're describing might work for someone in their 40s or 50s, but they're not appropriate for people in retirement. This conversation crystallized something important for Margaret. The financial advice industry had developed a set of assumptions about older investors that were not only incorrect, but potentially harmful. These assumptions were self-reinforcing because they were based on what advisors thought clients wanted to hear rather than what clients actually needed. Margaret realized that changing these patterns would require not just individual education, but broader changes in how the industry approached retirement planning. Advisors needed training in real return investing and inflation risk management. They needed to understand that retirees often had longer time horizons than conventional wisdom assumed, and that avoiding volatility could be more risky than accepting it. But she also realized that individual investors couldn't wait for the industry to change. People like Ruth needed better information and guidance immediately, not after the financial advice industry had reformed its practices. Margaret decided to expand her volunteer work at the library. Instead of just helping individuals research specific financial questions, she began organizing informal discussion groups for retirees who wanted to learn about investment strategies and financial planning. The groups met monthly and focused on practical topics like understanding investment risk, evaluating bond and equity funds, researching Treasury inflation-protected securities, and developing personal investment policies. Margaret didn't provide specific investment advice. She was careful about that. But she taught people how to research and analyze their options independently. The groups proved popular, attracting not just retirees but also people in their 50s and 60s who were beginning to think seriously about retirement planning. Margaret was surprised by how many participants had never been taught basic concepts like the difference between nominal and real returns, or the relationship between inflation and purchasing power. "I've been working with a financial advisor for 15 years, one participant said, "and no one has ever explained to me why earning 2% on my savings account might actually mean losing money." These conversations reinforced Margaret's belief that financial education was crucial for successful retirement. The participants in her discussion groups weren't lacking intelligence or motivation. They were lacking information and analytical frameworks that would help them make better decisions. Over time, the discussion groups evolved into something more structured. Margaret developed handouts and worksheets that helped participants analyze their own financial situations and evaluate different investment options. She created reading lists and resource guides that directed people to reliable sources of information about retirement investing. Most importantly, she helped participants develop the confidence to ask better questions of their financial advisors and to challenge conventional wisdom that might not serve their interests. "The most important thing you can do," Margaret would tell each new group, "is to understand your own financial situation well enough that you can evaluate the advice you're receiving. Don't just accept recommendations because they sound safe or conservative. Understand what those recommendations are designed to accomplish and whether that aligns with your actual needs and goals." 1 year after she had started helping Ruth with her investment questions, Margaret received an unexpected phone call from Charles, her financial advisor. "Mrs. Whitmore, I have an unusual request. I've been hearing from several clients that you've been helping people in the community understand investment concepts and retirement planning strategies. I'm wondering if you might be interested in doing a presentation for some of my clients about the topics we've discussed." Margaret was intrigued but cautious. "Charles, I'm not licensed to provide investment advice, and I wouldn't want to create any problems for you or your clients. I understand that, and I'm not asking you to provide advice, but I think many of my clients could benefit from hearing about your experience and the research you've done about inflation risks and real return investing. You could share your story and the educational resources you've found helpful without making specific recommendations about what people should do with their money." Margaret agreed to give a presentation to a small group of Charles's clients. She spent several weeks preparing, developing a talk that focused on her personal experience, while providing educational information about concepts like inflation risk, real returns, and the hidden dangers of supposedly safe investments. The presentation took place in the conference room at Charles's office on a Saturday morning. About 20 people attended, most of them retirees or near retirees who were concerned about their financial security. Margaret began by sharing her story, how she had initially chosen conservative investments that she thought were safe, how she had gradually realized that these investments were failing to protect her purchasing power, and how she had educated herself about different approaches to retirement investing. "I want to be clear that I'm not here to tell you what to do with your money," she said. "I'm here to share what I learned about asking better questions and thinking differently about financial risk." She explained the difference between nominal and real returns, using her own experience as an example. She showed how investments that seemed safe in nominal terms could be quite risky in real terms if they didn't keep up with inflation. 3 years ago, I thought the biggest risk I faced was losing money in the stock market, she said. I didn't understand that I was already losing money to inflation by keeping my investments in savings accounts and low-yielding CDs. Margaret also discussed the 3 specific investment mistakes that she had made and that she believed were common among retirees. She explained why cash and cash equivalents could be particularly dangerous during inflationary periods, why CDs might provide less safety than people realized, and why dividend stocks from mature companies might not provide the inflation protection that many investors expected. But she also emphasized that these problems were solvable. She discussed Treasury inflation-protected securities, international bond funds, and equity investments focused on companies with pricing power. She explained how these alternative approaches might provide better long-term purchasing power protection, while acknowledging that they came with different types of risks. "The key insight for me," Margaret said, "was realizing that I couldn't avoid risk entirely. I could only choose which risks to accept. By trying to avoid the risk of short-term volatility, I was accepting the risk of long-term purchasing power decline. Once I understood that trade-off, I could make better decisions about how to invest my money." The presentation lasted about an hour, followed by 30 minutes of questions and discussion. Margaret was struck by how engaged the audience was, and by how many questions focused on practical implementation rather than theoretical concepts. "How do you research Treasury inflation-protected securities?" one person asked. "What should I look for when evaluating international bond funds?" asked another. "How do I know if a company has pricing power?" asked a third. These questions suggested that the audience was ready to move beyond conventional approaches and explore alternatives that might better serve their long-term interests. They weren't just looking for reassurance. They were looking for actionable information that could help them make better financial decisions. After the formal presentation ended, several people approached Margaret individually with more specific questions about their situations. She was careful not to provide investment advice, but she offered to help them research their options and understand the concepts that might be relevant to their decisions. Charles thanked Margaret after the last participant had left. "That was exactly what I hoped it would be. You helped people understand concepts and trade-offs that I sometimes struggle to explain clearly." Several people mentioned that they want to schedule follow-up meetings to discuss changes to their portfolios. "I'm glad it was helpful," Margaret said. "I think many people are ready for a different approach to retirement investing, but they need information and education before they can feel confident making changes." Over the following months, Margaret gave similar presentations to several other groups: a senior center, a retirement planning club, and a continuing education program at the local community college. Each presentation was slightly different, adapted to the specific audience, but the core message was always the same. Conventional wisdom about safe investments for retirees could be dangerously misleading, but better alternatives were available for those willing to research and understand them. The presentations also reinforced Margaret's belief that her experience was part of a much larger pattern. Everywhere she spoke, she met people who had made similar investment mistakes, who were struggling with the same purchasing power challenges, and who were ready for better information and guidance about retirement investing. But she also met people who had successfully navigated these challenges using approaches similar to what she had adopted. These individuals had typically discovered, through their own research and experience, that traditional retirement investing advice was inadequate for their needs. "I figured out 15 years ago that my savings account was losing buying power," one man told her after a presentation. "I started putting money into tips in international bond funds, and my purchasing power has actually improved during retirement." "My father made the mistake of keeping all his money in CDs during the 1970s, a woman explained. "I watched his standard of living decline year after year, and I was determined not to make the same mistake." These conversations highlighted both the challenges and opportunities facing retirees. The challenges were real. Conventional wisdom was inadequate, many advisors were poorly trained in inflation risk management, and the financial services industry was slow to adapt to changing economic conditions. But the opportunities were also real. Information about better investment approaches was available for those who sought it out. Financial products that provided inflation protection were accessible to individual investors. The tools and resources needed for successful retirement investing existed. They just weren't being widely promoted or explained. Margaret's role, she realized, was not to provide investment advice, but to help people understand that alternatives existed and to give them the knowledge and confidence to explore those alternatives. She was functioning as a bridge between academic research about retirement investing and practical implementation by individual investors. 3 years after her own financial awakening, Margaret reflected on how much had changed in her understanding of retirement investing and financial security. She had started as someone who feared market volatility and sought the safety of guaranteed returns. She had evolved into someone who understood that true safety required accepting some volatility in exchange for better long-term purchasing power protection. But perhaps more importantly, she had evolved from a passive recipient of financial advice to an active participant in her own financial future, and eventually into someone who could help others make similar transitions. Her story had become more than just a personal journey of financial recovery. It had become a case study in the importance of financial education, the dangers of conventional wisdom, and the possibilities that opened up when people took control of their own financial destinies. Margaret's experience offered both warning and hope to other retirees facing similar challenges. The warning was that supposedly safe investments could be dangerously inadequate for protecting purchasing power during inflationary periods. The hope was that better alternatives were available, and that it was never too late to make positive changes to one's investment strategy. As she looked toward the future, Margaret felt confident not just about her own financial security, but about her ability to continue learning and adapting as economic conditions changed. She had developed the knowledge, skills, and mindset needed for successful long-term retirement investing. But she had also developed something equally valuable, a sense of purpose, that came from helping others avoid the financial mistakes she had made, and from contributing to a broader understanding of what successful retirement investing really required. Margaret's transformation from financial victim to educated investor to community resource had taken nearly 4 years. It had required considerable effort, study, and occasional discomfort as she challenged her own assumptions and faced her financial fears. But the results, both financial and personal, had been worth every hour of study and every moment of uncertainty. She had not only secured her own financial future, but had also found a way to help others secure theirs. Her story was ultimately about the power of knowledge, the importance of questioning conventional wisdom, and the possibility of positive change even in the later stages of life. It was a story that offered both practical guidance and inspirational hope to anyone facing the challenges of retirement in an uncertain economic environment.